Hey guys, welcome back. We had quite a turbulent week on equity markets, so I wanted to give you my overview of where stock market could go in short term, mid term and long term. I will show you several different metrics which are basically telling you if stock market is expensive or not, and I will also give you different point of view which is not quite simple like just looking PE of S&P 500 and deciding if it is expensive or not. And of course I will also let you know what am I going to do next week and then in the midterm, and also what is my approach towards long-term investing. How am I going to position in this volatile environment and much more. But again, as always, just a quick overview of my portfolio. You can see that it dropped quite significantly as most of a portfolios last week. My cash position has increased a little bit, and I will of course disclose to you what I actually did. Again, this chart which compares S&P 500 with my portfolio still isn't working, so I actually manually made chart which compares my return, and you can see it here. My return is approximately 4.2%, while S&P 500 is negative 1%. And what changes did I do in my portfolio? I actually sold 300 stocks of PRDO and I bought 10 stocks of Facebook. In total, my cash position has increased almost $1,000. There is no some particular reason why I sold PRDO. I simply wanted to add more Facebook stocks. I think they destroyed fourth quarter. But again, I didn't want to decrease my cash position. So I had to sell one position. And yeah, PRDO is enigmatic to me. It's really cheap stock. But again, it's hard to find additional information about this company. So I simply wanted to liquidate it. And yeah, I lost $700 from this position and I had to do better on this one. I didn't do my homework, to be honest, so yeah, and I paid price for it. But let's move to today's topic. S&P 500, as you can see on this chart, actually went from 3,830 points to a little bit above 3,700. It's not such a significant drop, but again, people are starting to be more and more nervous. When you see a few days in a row S&P 500 going down by 1% and a lot of tech companies going down for a lot more than that, when you see your portfolio going down 5, 10, 15 or even 20% in a week, a lot of people are starting to get nervous. So I simply wanted to go and check some data with you guys to let you know how much should you worry. Of course, nobody knows in a short run where stock market is going to go, but there are some indicators which can at least show us what could happen in a short run. So of course you have all seen S&P 500 PE ratio and it's extremely high. I have actually made this red line as an average. It's approximately at 15 and right now we are at 37. So if you look only this one single metric, you might panic a little bit, you might liquidate all of your position, hide under the bed and wait for a huge crash on stock market. But yet again, PE ratio of S&P 500 actually was about 20 for last 6 or 7 years. If you would have tracked only this one single metric, you would have missed a lot, and I really mean a lot of gains in the last 5 or 6 years. So of course you have to get a bigger picture. We can of course check Warren Buffett's indicator, which measures market cap of Wilshire total market compared to GDP. And basically, whenever GDP went below Wilshire total market, that meant that stocks are expensive. And you can see here that after the 2015, these two lines completely decoupled. And also based on this metric, stock market is also extremely expensive. And also I could show you several another different charts which are pointing that stock markets are extremely expensive. What you have to bear in mind when you are checking if S&P 500 is expensive compared to historical data, when you are doing an investment, you have to discount cash flow that your investment is going to generate in the future. I'm not a big fan of this method when I am investing in stocks because I think that it's almost impossible to forecast how much of free cash flow is some particular company is going to generate because there are a lot of parameters which affects how much money or free cash flow is company going to generate. But let's ignore my personal opinion. And what is percentage point that most of the investors are discounting their investment? Well, again, there is not unilateral opinion about this, but most of the investors are using yield 10-year treasury bond of a country in which they are investing their money. And as you can see here in last 50 years or so, yield on 10-year treasury of United States was between 5 and 15%. So if you are discounting your investment with a 5, 10 or 15% yield, PE ratio of your investment, for example in this case S&P 500, should be between 10 and 15, which if you remember my first chart, historically it has been. But what happened actually in last 10 years, as you can see on this chart, yield on a 10-year treasury went far below 5%. You can see here it went to 4%, then 2.5%, and right now we are sitting at 1%. So consequently, if you are using 10-year treasury yield to discount free cash flow of a company in which you want to invest, and in this case it would be 1%, you would get really high price. So if you compare equity valuations to a bond valuations and bond yields, I actually don't see that stocks are overvalued. Again, it's really important to note here that we are just comparing historical ratio of stocks compared to bonds. Not to mention, for example, a lot of European bonds, for example, German bonds, Austrian bonds, are yielding negative yield. So theoretically, if we are investing in European companies, and if we are discounting cash flow of some German company with negative yield of German bond, price which we should pay for that company is infinite. Of course, it isn't the case. Investment has its price. But again, this isn't something that you should blindly follow, but you should put equity prices in a context of other investment classes. You do know what is, for example, yields that you are paying on your mortgage payment, what is yield you are generating on your bank account. And when you take those metrics into consideration, is 2%, for example, dividend yield of S&P 500 really so expensive? Is PE of 35 of S&P 500 really so extremely expensive? Of course, stocks are not cheap by any means. That is why I'm holding quite significant amounts of cash in my portfolio. But I'm not so scared and bearish on equities, even though those first few charts are showing that you should be extremely scared. But again, if you would just follow those few simple metrics, you would probably sell all of your equities in 2015, and you would still be waiting for a crash on stock markets and for a pullback on those metrics. So as long as bonds are yielding such a low yields, I think that stock market actually deserves to be on higher multiple than they have been in the last 50 years or so. What are those multiples? Should they be really 37 as they are right now, or they should be at 20 or 23 or 25? I really don't know. But I'm just trying to say that keeping eye on only one metric isn't enough to make a decision if stock market is expensive or not. Another nice index that I like to take a look at is Fear and Greed Index. It is really short-term index, which tells you if investors are fearful or greedy. It goes from 0 to 100. Only 1 week ago we were at 60, and right now we are in red. We are at 35. You can see at Thursday we were at 41, right now we are at 35. In March we were actually at 3, and just before that crash on March, when we were near all-time high, Fear and Greed Index was at 99. So again, this is short-term index, which actually tells us, and then in this part I can actually start giving you my personal opinion of markets and what am I going to do. Of course, nobody knows what markets are going to do. I'm not pretending that I do. But based on all of these metrics, on the short run, I think we are starting to bottom down. And this is perhaps, even if on Monday we decline for a few more percentage points, this is a good entry point. And I will perhaps buy some more stocks. On a mid-term, in next 3 to, let's say, 24 months, again, compared to bonds, yields on bonds, I also don't think that stock market is overvalued and that we should be afraid of huge crash. Again, multiples are near all-time highs. So pullback of 5 to 10% isn't something that should surprise us, but I don't necessarily expect that we should have huge crash just because stock market is trading at a high multiples. But at the long run, I do not expect in next 10 to 20 years double-digit returns on S&P 500 if you invest near these levels. That is why I am actually constantly tracking a lot of different metrics. I am constantly rearranging my stock portfolio from more aggressive one, which means basically that I'm investing more into tech stocks, to more defensive one. If I dislike situational markets, I will invest in value stocks, in cheap stocks, Berkshire Hathaway, gold companies, etc. If I'm bullish, if I'm less scared, I will invest more into tech companies. And then second thing I'm doing is I'm always keeping between 10 and 30% of my portfolio into cash. So if I'm scared, if I see that S&P 500 is going to 3,800, 3,900 or it's nearing 4,000 points, I will simply start increasing my cash position and cutting exposure to expensive companies and playing more defensively. Because if you want to generate double-digit return, and that is for sure my goal for a long run, for a future, I feel that I must take advantage of every single pullback on the stock market, and I must always keep some part of my portfolio into cash and to invest whenever we have a pull down on stock market. Because if I would simply be investing all of my cash at any given moment near these high valuations, I am quite confident that even though I'm doing my best to invest money in undervalued stocks, won't be able to generate double-digit return. So once again, On a short run, I think this is a good opportunity to perhaps invest some of your cash that you are holding and into a stocks that you are watching. On a mid run, also I'm not so scared because again bonds are yielding very low yields. Dollar is relatively low, so US companies are going to do well. But on a long run, you have to be careful and you have to simply be patient and to wait for a good opportunities if you want to outperform S&P 500 and if you want to generate double-digit return.